Our topic for today is how does your credit score impact your loan, your mortgage loan? So first of all, it's very good to understand what is composed of for your credit score. Your credit is derived from three separate agencies, and that is Equifax, TransUnion, and Experian. Those three agencies have to use different algorithms in order to establish what your points are. So even though they're using different algorithms, the point system that they have to use is basically the same. So if we could use an analogy, credit is a lot like a pair of scales. When something goes on your negative side of your scale, the weight is there. Therefore, it brings your score down. When something is put on the positive side of your scale, that can even out that score. So using that analogy, that helps us to understand that even if you have quite a few things on the negative side, by just paying those items off, is that going to be enough to lift that score up? No, it won't. That's why we have to also establish positive credit. Well, how do you do that? Let's say that you do have a low credit score and no one wants to offer you a credit card. Well, there's a way. They're called secured credit cards. And by their very definition of being secured, what that means is that is a card that you give money to securitize it, to prove that they're going to get their money back because you've already given it to them. So let's pretend that you Google the top 10 secure credit cards, you pick one there. Once you receive the card, the next step is to make sure that you use it a little bit. Well, what do we mean when we say a little bit? We mean less than 30%. So let's use easy numbers. Let's say we get a credit card for $100, then you want to make sure that you don't use any more than $30 on that card. Therefore, your usage is very low. So what does that do? Well, that translates into an algorithm and mathematically tells the repositories over here, hey, they have the ability to use $100 and they're only using $30. It gives you more points. And those points go to which side of your scale? The positive side of your scale. So the more that you do that, what it does is it puts weight, heavy weight, on the positive side, thus lifting up the negative. Installment loans also can do that, but they don't put as much weight as a revolving. So hopefully this helps you to see how the credit mechanism works and why it's so important to talk to a loan officer before you manipulate your credit yourself to make sure that you're doing things that will help you to achieve your dream of home ownership.